Hey YouTubers, good evening, good night, good morning, wherever you're watching this transmission. Tis I, Mike Martins. Sorry about my attire here, but I was just doing some video game discussion talk, blah blah blah. Some of the other stuff I do usually. One of my hobbies, I guess, if you want to put it that way. But I actually want to discuss something of utter importance here. I'm just opening the article, here it is, inverted yields. This is very important in reflection to the housing market. It's very simple because I think markets, the way the markets are looking right now, we are in a geopolitical huge uncertainty in the markets, and I think the risky markets like housing and marijuana and markets and stuff like that, like those kind of markets that are really volatile, I think it's a little bit shaky right now, and things look really shaky right now because of this geopoliticalness. We're not certain what's happening in the world, and it's affecting obviously the bond markets and all that other stuff, right? Price of gold and all that stuff, right? So I just wanted to, I want to ask you guys, is the housing market considered a risky market? It's one question I rarely ever ask, but is it considered a risky market, or is it, yeah, it's going to keep going up? Everyone believes it's in Vancouver, it's going to just keep going up. Toronto right now is in a huge decline. They're seeing what being underwater means, right? But this article was just, what time is it? This thing was actually written less than 30 minutes ago, and I actually want to read this to you guys because this is so important, because I believe it has to do with the market right now, with the housing market a lot. A lot of people don't understand that the big crash in the 1930s, after the Roaring 20s, in the 1930s, a lot of people didn't know that one of the underlying factors of the big market crash was housing was a huge underlying factor, and no one ever states that. You can look it up, it's on record. Housing was huge factor in the downturn of one of the greatest market crashes at the turn, just after the turn of the century. So yield curve, what is a yield curve? So the article states the yield curve just inverted. For a lot of people that don't know, it's basically a line, and what it does, it just positions itself on a graph, and it tells you maturity dates and when bonds are going to be cashing out. If you have a shorter yield, like a shorter time, higher risk, the yield is higher. But if you have longer term bonds in, obviously the rates are going to be somewhat depending lower, but less risk, and they have always different maturity dates, and it goes right here. I have it here actually opened. It goes from 3 months through treasuries. It says here 3 months, 6 months, 1 year, 2 year, and then if you do a 30-year, depending and what the treasuries are at, and I'm just reading what this little blurb says here. It has nothing to do with what we're talking about. But the yields is used to issue some like a benchmark for other debts, and that's why I'm bringing this up in housing. It's because it has to do a lot with what the mortgage rates are at right now, and it dictates kind of like the future, to look ahead in the future. And bank lending rates, it has a lot to do with, it also predicts, the yield curve predicts economic changes in the future too. So this is really important. So I'm just going to get to the point here. I'm just going to read this because I'm talking way too much. The yield curve just inverted. As we have told readers, we have been keeping our antenna up for signals that an economic downturn may be on its way. Well, the biggest one of all just showed its head. And investors need to take notice. An important part of the rates market just showed an inverted yield curve right here. Inverted yield curve. This is a normal yield curve. The 1 month U.S. overnight index swap rate is now inverted, and this implies some expectation of lower Fed policy rate after the first quarter of 2020, says J.P. Morgan. Hold on, let me just close that. J.P. Morgan, the bank summarizes the situation this way, saying an inversion at the front end of the U.S. curve is a significant market development. So, guys, this is huge, okay? Because you have different yield curve. You have a normal yield curve that just goes like that, normal, sloping upwards. And then you have an inverted yield curve. And downsloping suggests that yields are no longer term bonds, I guess, if you want to put it that way. And they will continue to fall if that continues, right? And in all fairness, I'm just trying to think what I remembered in high school. And then it lacks demand for shorter term investing, so that becomes another big problem. Remember, guys, I'm not an investor, right? I'm just talking about basically it's downsloping the future investors for investing in market if that is happening. And how does this tie into the housing? Well, let me get to this sentence right here. Not least because it occurs rather rarely. So it's a huge development because it happens very rarely. It also generally perceived as a bad omen for risky markets. So this is very important because is housing a risky market right now? Is your $300,000 typical house, is it really worth $2 million? I think that's very high risk. I think it's very volatile because going nowhere but up in Vancouver and then out east, Vancouver, California, Seattle, Washington State, Portland, Oregon, it's the same thing. Everything's going up. And now let's look at the second part of this. It says, if the market thinks rates are going to be lower in 2020, that means parts of the bond market are expecting a recession between now and then. Take notice. So this is very important. Then you have flat yield curves where things aren't changing economically that much, and the economic conditions, depending on where rates are going, and if they become longer on maturity bonds, depending on what bonds you're in. So maybe picking up, I'm gonna have to pick up a book. It's been a while. I'm gonna look at bonds for dummies or investing in bonds for dummies because it's been a while with the lingo for myself. But I have a feeling that this is gonna coincide with what's happening in the housing market. This does not look good on an economic platform. You know, I just wanted to put this out there for you guys. You know what I'm saying? Inverted yield curve. Lower prices, higher yields on shorter term securities is usually the case, if I remember right. And then it's just going to bring it down further. Guys, I'm just thinking. I'm just putting this out there. This is a big deal, actually. This is actually a bigger deal than I thought after reading this article here. I want to know what you guys think. If you guys know, I want to know your opinion on this. I'm just kind of lost for words. I don't know why this is. I think this is just freezing up on me here. Let's see what this thing says. Normally, short-term yields, long-term bonds, but when the Fed raises the short-term rates 1 year or less, intermittent long-term rates can fall. It can fall below the rates. You'll find for short-term offerings, this is an inverted yield curve when short-term rates are higher than longer-term rates. Don't be tempted by short-term yields. However, when the short-term bonds mature, you may need to invest those funds somewhere else. By then, if the economy has slowed, intermediate long-term bond rates may have already fallen a lot. What should you do? So, here we go. So there's the rates right here. A 2-year, 1.71, and then there it is here. So yeah, it's the rates are not. They're inverting here for what, depending on the plus minus rate. This has been a long time, guys, since I actually touched on this. So I'm really sorry, guys. I'm really sorry. I just wanted to put this. I can't move this thing up. It's not letting me move this article up. I want to go back to the top. So I think this will affect huge the housing market, because I've never seen. Because the last time, when was the last time the yield has inverted? Last time tied. It's predicting a recession. When was the last time? That was the yields on 6-month, 1-year Treasury bills. What's happening here? Ah, here we go. When the inverted yield curve last forecasted a recession, the Treasury yield curve inverted before the recession in 2000, 1991, and 1981. The yield curve also predicted the 2008 financial crisis, 2 years earlier. The first inversion occurred December 22, 2005. The Fed worried about the asset bubble in the housing market. Bingo. That had to be raising the Fed funds rate since June 2004. By December, it was 4.25%. Bingo. That's what I wanted to see, guys. You got it here live pretty much before anybody else, before this hits the market floor tomorrow morning. Keep an eye on your portfolio, guys. Portfolios for your high-risk, volatile stocks. See where they're at. Remember, guys, I don't know anything. I really don't. I just want you guys to do your own research and see what's going on, especially where you're at, you know. I'm not telling you where to put your money. I'm not telling you how to invest your money. I just want you to be careful, is all. I just kind of, you know, bingo. Last article. I just looked it up. So it is forecasting something. What are we forecasting? And my main question to you guys, is housing considered a risky market? With this geopoliticalness that's going around, with the South Korea's dollar going down. I think Japan's yen or something is having problems too. And now with the China unpegged from the Federal Reserve, and who knows what's happening in Syria? No one even knows. Comment below, guys. I'm going to stop talking now. Leave your comments below. I want to know what you guys think. Thanks for watching.